Imagine Texas, the land of booming suburbs and endless growth, now cracking under the weight of its own housing bubble. Families are drowning in $4,000 mortgage payments, property taxes eating $10,000 a year, and insurance bills soaring past $5,000. Inventory is exploding, migration is reversing, and once safe bet cities are bleeding value faster than 2008. In 2025, the Lone Star dream is collapsing before our eyes. Let's count down the 10 fastest crashing housing markets in Texas. Number 10. Garland. Garland, tucked into the northeastern corner of the Dallas-Fort Worth Metroplex, is unraveling in 2025 under a perfect storm of housing pressures, economic stagnation, and environmental stress. Once seen as an affordable suburban escape, Garland has watched its median home price rocket from around $250,000 in 2015 to nearly $340,000 today, while household incomes average just $72,000. That leaves residents battling a price-to-income ratio of 4.7, a flashing red warning sign of a market that's become dangerously detached from what locals can actually afford. Migration trends are no longer Garland's savior. During the pandemic surge, families from out-of-state flocked here, cashing out of pricier markets and overbidding on modest homes. But the tide is shifting. With property taxes near 2.2% annually, about $7,500 a year on a $340,000 home, and insurance premiums spiking past $4,000 annually, many of those newcomers are fleeing again, leaving behind swelling inventory. Listings sit on the market for over 90 days on average, twice as long as in 2022, and nearly 40% of sellers are slashing prices by $15,000 to $30,000 to lure reluctant buyers. The local economy is showing cracks too. Garland once leaned heavily on light manufacturing and service sector jobs, but layoffs and relocations have trimmed payrolls. Retail hubs and strip malls are showing higher vacancy rates, and with mortgage payments above $2,500 a month at current 7% interest rates, families are cutting back on spending everywhere else. Investors who once gobbled up starter homes are now backing out as rents flatten around $1,700 a month, but vacancy rates climb, killing cash flow projections. Then there's the weather. Garland sits in one of the most hail-prone corridors in America, and storm frequency is surging. Recent flooding events and tornado warnings have driven insurers to hike rates or deny coverage, compounding ownership costs. What was once marketed as an affordable suburb is turning into a financial sinkhole where rising costs, job uncertainty, and climate risks collide. In 2025, Garland is no longer a bargain. It's a textbook case of a housing market sliding into collapse. Number 9. Cedar Park. Cedar Park, once hailed as one of Texas's fastest-growing and most desirable suburbs, is showing severe cracks in 2025. Located just northwest of Austin, this city rode the tech migration wave when companies like Apple and Dell expanded nearby, drawing in high-paid professionals. That influx sent the median home price soaring from under $300,000 in 2016 to more than $515,000 today. But with mortgage rates near 7%, the monthly payment on an average Cedar Park home now runs close to $3,800, including taxes and insurance. An impossible figure for most families, as local wages average just $84,000 annually. The growth that once seemed unstoppable has created its own downfall. Cedar Park's population swelled past 77,000, but infrastructure couldn't keep pace. Congestion on Highway 183 has become unbearable, schools are overcrowded, and residents complain of rising utility costs as water demand outpaces supply. Inventory has exploded nearly 45% compared to last year, with builders who gambled on endless demand now stuck with unsold homes. Even new luxury builds are seeing $50,000 price cuts, while resale listings linger for 80 to 100 days. The weather adds another blow. Extreme Texas summers have brought multiple 100 degrees Fahrenheit plus streaks lasting weeks, pushing energy bills over $400 a month and stressing the power grid. Insurance costs tied to hail and storm damage have climbed to nearly $4,500 annually, hitting homeowners already squeezed by property taxes near 2%. Migration trends are also reversing. Families who once poured in from California and New York for affordable luxury are quietly leaving as Cedar Park no longer offers a bargain, especially compared to nearby small towns where homes sell for $150,000 less. Cedar Park's downfall is a cautionary tale. Rapid growth built on tech money created unsustainable prices, and in 2025 the cracks are widening into chasms. Number 8. Round Rock. Round Rock, just north of Austin, is collapsing under the very forces that once made it a boomtown. This city was marketed as a family-friendly haven with good schools and corporate anchors like Dell Technologies. But those anchors aren't strong enough to hold back the storm. The median home price here hovers near $460,000, nearly double what it was in 2013, while household incomes average $87,000. With mortgage rates in the 7% range, carrying costs for a typical Round Rock home surpass $3,200 a month, forcing families to stretch far beyond sustainable limits. Population growth, once Round Rock's golden ticket, is now straining every resource. The city's population has surpassed 125,000, but the infrastructure hasn't kept up. Commuters crawl down I-35 in traffic jams that rival Los Angeles, and schools face ballooning enrollments. Rising property taxes, which average 2.1% or about $9,500 annually on a $460,000 home, combined with insurance premiums climbing toward $4,000, are driving locals to the breaking point. Builders who once couldn't keep up with demand are now watching inventories spike more than 40% year over year, with unsold homes offering incentives like free appliances and closing cost coverage. Adding fuel to the fire, Round Rock faces environmental pressures. Flooding along Brushy Creek has forced higher insurance claims, while extreme heat waves are pushing utility bills into the hundreds. Renters aren't spared either. Average rents of $1,850 a month are stalling as vacancies creep upward, eroding investor profits. Migration into Round Rock is slowing as families realize they can get more for less in smaller nearby towns like Taylor or Georgetown. Round Rock once symbolized suburban stability, but in 2025, it's becoming a portrait of overbuilding, overpricing, and overpromising. The city's housing market isn't just cooling, it's cracking under the weight of its own hype. Number 7. McKinney. McKinney, located north of Dallas, was once celebrated as the fastest-growing city in America. In 2025, that badge of honor has turned into a liability. The city's population exploded past 210,000, but the rapid expansion has overwhelmed infrastructure, driven housing costs through the roof, and left the market dangerously overextended. The median home price now hovers around $495,000, while median household incomes sit near $95,000. That leaves families stuck with a price-to-income ratio above 5, unsustainable for long-term growth. Inventory is piling up at an alarming pace. Listings are up 38% from last year, and the average home sits unsold for nearly 100 days. Price reductions are everywhere, with many homes slashed by $25,000 to $50,000 just to compete. Builders who once marketed McKinney as a can't-miss investment are now offering extreme incentives, covering HOA fees, buying down mortgage rates, or throwing in thousands of dollars in upgrades. Rents, averaging $2,100 a month, aren't keeping up with investor expectations either, leading to a flood of rental homes hitting the market. The local economy, heavily reliant on service jobs and corporate commuters to Dallas, is showing cracks. Retail corridors are softening, and rising living costs are driving some families to relocate to smaller, more affordable towns further north. On top of economic stress, McKinney faces environmental challenges. North Texas storms have grown more destructive, pushing annual insurance premiums above $4,200, while scorching summers raise energy bills to unsustainable levels. Migration patterns are no longer favorable. Many families who once rushed in are now fleeing for cheaper alternatives in Oklahoma or rural Texas. McKinney's dream of endless growth has backfired, leaving it as one of the fastest collapsing housing markets in Texas. Number 6. Irving. Irving, once marketed as the gateway city between Dallas-Fort Worth Airport and booming corporate campuses, is now teetering on a housing crash in 2025. For years, Irving benefited from its central location, drawing in employees from massive employers like ExxonMobil, AT&T, and several airline companies. That corporate magnet fueled rapid development, but the housing market has overheated beyond recognition. The median home price here has surged past $410,000, while median household income hovers just under $74,000, leaving families with an unsustainable cost burden. Monthly mortgage payments, with rates still around 7%, easily top $2,900 with taxes and insurance. What makes Irving unique in its collapse is its reliance on renters. Nearly 60% of Irving households rent, yet the average rent now exceeds $1,900 a month, with luxury apartments pushing $2,400. Vacancy rates are climbing as corporate relocations slow and younger professionals head to cheaper suburbs. Investors who once saw Irving as a cash cow are now liquidating, driving property values down. Meanwhile, property taxes at 2.1% and insurance premiums over $4,200 annually are gutting affordability. The city's infrastructure is another stress point. Aging neighborhoods in South Irving face flooding risks from the Trinity River, and storm insurance claims are rising. North Irving, built around Las Colinas, is clogged with overbuilt condos and townhomes that were designed for a never-ending flow of corporate workers. With remote work taking hold, that demand has evaporated. Combined with relentless 100 degrees Fahrenheit plus summers driving electricity bills beyond $350 a month, Irving is losing its competitive edge. Irving's problem isn't just high prices, it's an entire housing model collapsing. A city built to house transient professionals is finding that without constant inflows, its market cracks wide open. In 2025, Irving stands as one of Texas's clearest examples of a suburb collapsing under its own dependence on corporate momentum. Number 5. Denton. Denton, long celebrated for its college town vibe and artistic spirit, is spiraling into a housing downturn that few saw coming. Home to the University of North Texas and Texas Woman's University, Denton thrived on student-driven demand and a steady inflow of faculty, musicians, and creative professionals. But 2025 paints a darker picture. The median home price sits near $385,000, while the city's median household income struggles around $68,000, creating a price-to-income imbalance of nearly 5. Renters face no relief either, with average rents approaching $1,750 a month, pricing out even students who once found the city affordable. Overbuilding is Denton's Achilles heel. Developers flooded the market with apartment complexes near campus and tract homes on the outskirts, banking on endless growth. Now, with enrollment stabilizing and younger families priced out, supply has overwhelmed demand. Listings are up 42% year over year, and unsold new builds dot subdivisions on the city's edge. Builders are slashing prices by $20,000 to $40,000, offering free upgrades and still failing to move inventory. Investors who targeted student rentals are bailing as vacancies rise and cap rates crumble. The local economy adds fuel to the fire. Much of Denton's employment is tied to education, healthcare, and service jobs, sectors that haven't kept pace with spiraling costs. Meanwhile, rising property taxes at nearly 2.3% eat away at homeowner budgets, while insurance premiums tied to hail and storm risk average $4,000 annually. Add in oppressive summer heat, with utility bills spiking past $300, and the affordability crisis deepens. Migration trends also reveal cracks. Families once drawn to Denton's quirky charm and proximity to Dallas-Fort Worth are now skipping the city for smaller towns in Cook or Wise County, where prices are lower. What remains is a market oversaturated with homes, shrinking demand, and soaring costs. Denton's housing bubble, inflated by its college town growth story, is now deflating at high speed. Number 4. Frisco. Frisco was the crown jewel of North Texas growth, dubbed the boomtown of the 21st century as corporate campuses, luxury shopping centers, and gleaming schools sprouted overnight. But in 2025, the glitter is fading fast. Frisco's median home price now exceeds $620,000, one of the highest in the state, while median household income, though strong at $120,000, can't keep pace with ownership costs. With mortgage rates stuck near 7%, monthly payments for a typical home run nearly $4,800, including taxes and insurance. Even six-figure earners are feeling squeezed. Frisco's rapid rise is also its downfall. The city's population ballooned past 225,000, but infrastructure, roads, utilities, even water supply, has struggled to keep up. Families endure gridlocked commutes on the Dallas North Tollway, and utility bills have spiked as heat waves push electricity usage to record highs. Property taxes near 2% translate into $12,000 plus annually on a median home, while insurance premiums averaging $5,000 pile on more pressure. The real estate frenzy is cooling fast. Inventory has surged by nearly 50% year over year, with once-coveted luxury homes sitting unsold for 120 days or more. Builders are dangling extreme incentives: free Tesla chargers, $20,000 rate buydowns, or HOA fee coverage just to move properties. Price cuts of $50,000 to $100,000 are becoming common, a shocking reversal from the bidding wars of 2021. Rental markets aren't saving investors either. Average rents of $2,600 a month aren't enough to offset purchase prices, leaving landlords cash flow negative. Frisco also faces a migration backlash. Families who once viewed it as a dream suburb are now leaving for smaller, cheaper Collin County towns like Prosper or Little Elm. The city's glossy image, high-end stadiums, shopping, and tech campuses is now overshadowed by unsustainable costs and growing vacancies. Frisco's boomtown reputation has flipped into a warning sign. When growth outpaces reality, collapse isn't far behind. Number 3. Rio Grande City. Rio Grande City, sitting along the U.S.-Mexico border in Starr County, is often overlooked in Texas real estate conversations. But in 2025, it has become one of the state's fastest collapsing housing markets, and the reasons are uniquely devastating. For years, Rio Grande City attracted buyers with its affordability. Median home prices hovered around $145,000 in 2016. Today, prices have surged to nearly $230,000, while the area's median household income barely cracks $42,000. That's a staggering price-to-income ratio of 5.4, worse than many Texas metros known for being unaffordable. The collapse here isn't just about numbers, it's about migration and economic stagnation. Unlike booming suburbs near Austin or Dallas, Rio Grande City depends heavily on agriculture, cross-border trade, and public sector jobs. With supply chains disrupted and tariff tensions simmering, local employment is shrinking. Younger residents are leaving in droves, chasing opportunities in San Antonio or Houston, leaving behind an aging population with less buying power. Inventory has jumped nearly 40% year over year, and homes that once sold in 30 days now languish for 90-plus days without offers. Add to this the crushing cost of ownership. Property taxes in Starr County average around 2.3%, which means a modest $230,000 home still racks up over $5,200 a year in taxes. A massive hit against modest incomes. Insurance is another nightmare. Located in a flood-prone and hurricane-vulnerable zone, premiums are averaging $3,800 to $4,200 annually, with some insurers refusing coverage outright. Extreme summer heat, often topping 110 degrees Fahrenheit, drives utility bills into the $300 plus range monthly, adding to household strain. What makes Rio Grande City's collapse so severe is that it never had the strong economic base or high wages to cushion the blow. A housing bubble inflated by outside investors and federal aid during the pandemic is now unraveling, leaving locals trapped in homes they can no longer afford or sell. In 2025, Rio Grande City is a stark reminder that even small, overlooked markets can implode when fundamentals are ignored. Number 2. Dallas. Dallas, the giant of North Texas, is finally showing the cracks everyone feared. For years, Dallas thrived on corporate relocations, financial services, and tech expansions that fueled a runaway housing boom. By 2025, that boom has tipped into a bust. The median home price sits near $405,000, up from just $220,000 a decade ago. But with household incomes averaging $76,000, affordability has collapsed. Monthly mortgage costs on an average Dallas home now exceed $3,100, including taxes and insurance, a crushing burden even for middle-class professionals. Inventory tells the story of collapse. Listings are up nearly 45% year over year, and homes that once sold in days now linger for 3 months or more. Price reductions are everywhere, with $20,000 to $50,000 slashed off once bidding war-ready properties. Builders who gambled on endless migration have hundreds of unsold units across the metro, offering extreme incentives like mortgage buy-downs or even free furniture packages just to move inventory. The economic backdrop is worsening. Corporate relocations have slowed dramatically, and remote work has hollowed out the demand for high-rise condos and urban townhomes. Downtown Dallas office towers sit half-empty, draining the city's tax base. Property taxes, already averaging 2.2%, pile nearly $9,000 annually onto a median home, while insurance premiums tied to storm and tornado risk now average $4,500. Energy bills, swollen by record summer heat, push another $350 to $400 a month onto families already stretched thin. Migration trends are reversing as well. Families who once came for opportunity are leaving for more affordable states like Oklahoma or Arkansas. Investors who once considered Dallas bulletproof are liquidating, fearful of negative cash flow as rents stall around $2,100 and vacancies creep higher. Dallas isn't just cooling, it's in full-scale deflation mode, with its glittering skyline masking a market imploding from within. Number 1. Austin. Austin was the poster child of Texas's housing boom, a city transformed by tech giants, startups, and a reputation as the Silicon Valley of the South. But in 2025, Austin has become the state's most dramatic housing collapse. Home prices that soared to dizzying heights, median values peaking near $570,000 in 2022, have begun tumbling, now averaging around $520,000, with many neighborhoods seeing declines of 10 to 15% year over year. Pair that with a median household income of just $86,000, and the affordability crisis is glaring. Carrying costs for a typical home, including property taxes and insurance, easily surpass $4,500 a month, putting homeownership out of reach for much of the city's population. The root cause is over-reliance on migration and tech-driven hype. During the pandemic, thousands of Californians and New Yorkers poured into Austin, paying cash and inflating values beyond reason. Now, many are leaving as the shine wears off. Property taxes at 2.1% translate into $11,000 annually on a median home, while insurance premiums tied to hail, floods, and wildfire risks average $5,000. Remote work reversals and tech layoffs from giants like Tesla, Meta, and local startups have shaken confidence. Inventory has exploded nearly 60% compared to 2023, with luxury homes sitting unsold for 120-plus days. Austin's infrastructure hasn't kept up either. I-35 remains a clogged nightmare. Water shortages are looming from the Colorado River, and grid instability during extreme heat waves pushes utility bills beyond $400 a month. Renters aren't safe either. Average rents of $2,300 are stagnating as vacancy rates climb, leaving investors exposed. The city's once unstoppable migration boom is reversing, with families opting for smaller, cheaper towns in central Texas. Austin is the ultimate symbol of a housing market gone too far, too fast. The city that once embodied limitless growth is now ground zero for Texas's housing collapse in 2025, its fall as dramatic as its meteoric rise.